Hello everyone, this is Tejashwini Chiranjeevi. In this video, let's discuss about the RTP of Jan 2025 direct tax. Okay, the first question is the MCQ question. Let's look into this case study based question, people. Okay. Sagar LLP is an LLP unit set up in SEZ in the financial year 1819 for the manufacturing of textiles. Okay. The fulfills all the conditions under section 10AA. SEZ, all of us know SEZ will get the exemption of 10AA. They will get exemption under section 10AA. Okay. The details of the units from the financial year 2023-24 are given below. What are those? Profits of this unit SEZ is been provided 58 lakh. See, this profit includes both the domestic profit and the export sales profit. Remember, so export sales of the above unit received in India in the in the convertible exchange on or before 30th 9 2024 is 1 crore. Domestic sales of the above unit is 60 lakh. So basically, this point, what points you need to consider or keep in mind is that first of all, this Sagar LLP, this is an LLP which is established in SEZ. They are eligible to take this deduction of 10AA under normal tax regime only, but under a special under 115 BAC, you will not get this deduction of 10AA. Okay, great. And you have to see which year it has been established. If it is established under 10AA, you will get 100% of the export sales profit as the deduction provided for first 5 years, from first year of establishment up till 5 years. From 6th year to 10th year, you will get 50% of such profit as the exemption, see, as the deduction. So 2018-19, correct? What is it? 2018-19. So with regarding to this 2018-19, see over here, people, 18-19 is one place, no? So when it comes to your calculation of this, 18-19 is year 1, 18-19. Then 19-20, 20-21, 21-22 and 22-23. This year, this previous year concerned and assessment year, this assessment year would end up with the 23-24 AY. Both are same. I just taken the previous year as the base. Okay. So 23-24 assessment year is the last year up till which you could have taken 100% of the profits, export sales profit as 100% deduction. But however, it has crossed that path. No. We are in which PY, people? We are in the PY 23-24, which is nothing but AY 24-25. Hence, we are not eligible to take 100% of the profits as the deduction. We will be eligible to take only 50% of the profits as deduction. Clear? Great. Now, when it comes to the next point, what they have stated is that they have stated profits of unit located in SEZ 58 lakh. That is the total profit. This is the total profit from the sales, domestic sales and export sales, remember. And always remember those export sales wherein the profit from the export sales which you can take as deduction would be those where the foreign exchange, whatever you are supposed to bring, convertible foreign exchange, you should bring within 6 months from the end of the financial year in which you are making this sales. That is end of the financial year is nothing but the previous year 23-24. No, 6 months down the line means 30th 9 2024 would be the correct. What it is, 30th 9 2024 would be the time. So this entire sales of 1 crore rupees, whatever you have considered, this is eligible for the purpose of the export turnover, wherein the profit is available for deduction. Clear? Let's move forward. Let's discuss the question. Sagar LLP has 3 partners. Basically, how many partners, people? Come on, tell me. How many partners? 3 partners. Mr. Ram, Shyam and Ganesh. Okay. Mr. Ram and Shyam are working partners. Fine. Why Mr. Ganesh is a non-working partner? People, why is this section provided? Because there's a point under section 40B wherein non-working partners would not be eligible. That is, the remuneration which is paid to the non-working partners would be disallowed under Income Tax Act 1961 under section 40B. Under section 40B, this would be disallowed, no? So what you should do is that whatever the remuneration which is paid to Mr. Ganesh should be disallowed under section 40B in your computation. Very well, we'll see. All the 3 partners are receiving remuneration of 1 lakh per month. So it is going to be for one partner, it is going to be 12 lakh. So three partners, total amount which is paid from the partnership firm would be 12 into 3, that is nothing but 36. 12 into 3, that is 36 lakh would be paid. But out of this, how much is disallowed? For one partner, it is disallowed. So 12 lakh would be disallowed. This is going to be disallowed because this is paid to non-working partners. This is a very important point. We'll discuss about it in the MCQs as well. Okay, concentrate people, listen. So, whatever the remuneration which is paid, it is already debited to the P&L account. Already debited to where? Already debited to P&L account. Very well. Apart from this, Mr. Ganesh was employed in XYZ, good fellow, till 30th 9 2023 and having salary of 80,000 per month. He resigned then and decided to start his own business. He resigned and decided to start his own business. Now, how much is the salary that he has earned, people? 80,000 is the salary per month. No. How many months he has worked? For 6 months. So, 80,000 into 6 months if you do, how much would you get? 8.4 lakh. But wait, your calculation has not been completed here. We will get standard deduction. No, we will get standard deduction of up to 50,000 rupees. So how much would be your taxable salary under this XYZ Limited where Mr. Ganesh has received? It will be just 4.3 lakh, 4 lakh 30,000. Clear? Great. He set up a warehousing facility in Pune for storage of agricultural produce, fulfilling the conditions for claim of deduction under Section 35A. Very well. He had established the warehousing facility for storage of agriculture, which is eligible for deduction of capital expenditure 100% under Section 35A, except the land. Remember, except the land. Agricultural expenditure, that is except land, goodwill and financial instrument you will get, but here in this case it is going to be land. See, a capital expenditure which this fellow incurred is 90 lakh, very well, including the cost of land. Land shall be disallowed to be disallowed as the expenses. Capital expenses which is incurred for land cannot be allowed, it is disallowed. So it is going to be how much? 30 lakh was incurred during the PY 23-24. The warehouse became operational with effect from 1st December 2023. The profit from the operations of the warehousing during the financial year is 1 crore 10 lakh. How much is that? This fellow has earned 1 crore 10 lakh. 1 crore 10 lakh. Okay, 1 crore 10 lakh minus the 30 lakh. Now tell me, people, cost of land is 30 lakh. No, so allowable capital expenditure is 90 minus 30 lakh, nothing but 60 lakh is deduction which is allowable under section 35 AD. Correct? Under section 35 AD, so much is allowable. Now, how much is the profit this fellow has earned? 1 crore 10 lakh. Out of that, deduction which is available is 60 lakh. So, how much would be taxable profit? How much would be the profit that would be subject to tax? 50 lakh. He pays a lump sum premium of 90,000 towards health insurance of his self and his for self and his wife, age 43 years, for 36 months on 1/10/2023 by account paid check. See here, this fellow took it not only for 1 year, but he took it for how many financial year? Let's consider 23-24. He started on 1/10/2023. So it started on 23-24. So he took it for 36 months. So it went up to how many? Here it is 6 months. 23-24, 24-25. Here it is 12 months. 25-26. Here it is how many months? 24 months. So the total is 30 months. So it went up to 26-27. That is 6 months. Total has come up to 36 months, which means it is 4 financial year. This 90,000 rupees will be allowed as deduction for 4 financial years. So 90,000 divided by 4, how much would you get? 90,000 divided by 4, how much would you get? 22,500 is something that you would clear. 22,500 is something that you would get as your premium. That is something you can take as deduction under section 80D. Under section 80D you would get. He also contributes 1,50,000 towards PPF. What is it? Towards PPF. This is however available as deduction under section 80C. Very well. This is the situation. You should remember this point. That is lump sum premium payment. So much is the amount. Clear? From the following information given above, choose the most appropriate answer. Very well. See, what is the amount of remuneration allowable as deduction. What is the remuneration which is allowable as deduction to the LLP for AY 24-25 under the head profits and gains of business or profession? How much is the allowable remuneration is what they are asking. Correct. First of all, you have seen how much is the remuneration that they have actually paid, 36 lakh. Allowable, in order to calculate allowable remuneration, you need to know the book profits. No? How do you get the book profits? Here it starts with the profit. It starts it starts with the profit that you have already earned. From that, you are going to add back the remuneration which is already paid. Then you will get your book profit. Out of that book profit, up to that is for that book profit, whatever you are considering, what is the provision states? 3 lakh rupees, up to 3 lakh rupees, or if in case of loss or up to 3 lakh rupees, you can take 1,50,000 or 90% of that book profit, whatever you have considered, 3 lakh, whichever is higher, you would consider for the first stage. Second stage would be up to 60%. No, up to 60% on the remaining amount you would consider for the book profit. See now, so the first one would be the profit you are adding. Then you are adding the remuneration which is debited in the P&L. How did you get this 36 lakh? Or 1 lakh per month for 12 months for 3 partners. You got book profit of 94 lakh. From this 94 lakh up to 3 lakh of the book profit, 1 lakh 50,000 or 90% of the book profit, the total has come up to 2.7 lakh here. And for 60% of the remaining book profit, 94 lakh is provided. Out of that 3 lakh which is already considered, the remaining is 91 lakh. That into 60%, you got 54.6. Now the total of this plus this, the total is 57.3. But however, this is the total deduction as per the calculation, or your actual expenses that you have paid, which is allowable as per income tax. Whichever is lower would be considered for the purpose of maximum allowable deduction. See here, these 3 partners, out of these 3 partners, as we have discussed earlier, this one fellow, Mr. Ganesh, is a non-working partner, people. This fellow, whatever we are paying, the firm is paying, that will not be allowed as per income tax. So it is just going to be the 2 partners, 1 lakh into 12 months into 2 partners, 24 lakh would be the deduction that is going to be allowed as your calculation. As per your section 40D, the maximum remuneration which is going to be allowable is going to be so much. That is option D would be the answer, 24 lakh. Clear? I hope it is clear. Let's go to the next question. Very, very quick. I hope everyone are active. Okay, please stay active. What is the amount of deduction available under section 10AA to Sagar and under section 35AD, that is 10AA and 35AD, to Mr. Ganesh? How much 10AA, how much is the deduction that they are getting under section 10AA to Sagar LLP and 35AD under to Mr. Ganesh under the Income Tax Act 1961 for AY 24-25? What is the deduction that is available? People, 10AA, how you are going to calculate 10AA? First of all, we have already discussed when is this calculation going to be, when is this Sagar LLP got established in 1890. So 5 years over the period, it means to state that it started in 1819. So 1819, 1920, 2021, 21-22 and 22-23 concerned. How much is the calculation going to be for 5 years? It is 100% of the profits going to be considered as deduction. But now what previous year which we are in is 23-24, which is from 6th year to 10th year, you can take 50% of the profits as deduction. Correct? But there's a small catch over here, people. There is a point wherein it states you have certain expenses that need to be disallowed. No? So that is nothing but 58 lakh is your total amount. Out of that, you have to disallow 12 lakh rupees. What is the 12 lakh rupees? Mr. Ganesh, you have paid non-working partner, which is already debited to P&L, which is disallowed. Disallowed means you are going to add back. No? Add back means 12 lakh add back. Total is going to be 70. Now, out of this 70, you are going to make the calculation. Out of this 70, how much is that you are going to consider the in the calculation? See here, very simple. Profits plus what I've done is that instead of taking 12 lakh, 36 lakh minus 24 lakh, 12 lakh is the net effect. No, I've taken it separately. Debited 36 lakh minus remuneration allowed 24 lakh. Total I've got 70 lakh. Okay. Out of the 70 lakh, whatever I've got, this is for the total turnover of 100 lakh, that is nothing but 1 crore plus 60 lakh, This is nothing but the export sales. This is nothing but the domestic sales. Correct. The total, if this 70 lakh rupees is pertaining to the total sales of 160 lakh, how much is it going to be for 100? Understanding people, this 70 lakh is the profit for total of 160 lakh. How did you get total 160 lakh? My wonderful, beautiful people, this is the total 100 plus 60. Export sales plus domestic sales. Clear? So now how much you're going to get is total is, if after you do the calculation, you'll get 43.75 lakh. Out of this one, 50% is going to be allowed as deduction. That is coming up to 21.875. So 21.875, and for 3580 it is going to be very simple. Excluding this cost of land, whatever the deduction, total 90. Out of that minus 30, if you do 60 lakh. The 60 lakh is the deduction that is available under section 3580. So the option is going to be B, 21.875, and 60 lakh is the deduction which is allowed. Clear? Great. What is the total income of Mr. Ganesh under the regular provisions of the income tax? If you are considering the total income of this fellow, what are the income that is considered under Ganesh? One, the remuneration which this fellow has received. As of now, remember, remuneration which this fellow has received from Sagar LLP, salary which he has received, and this 35 AD, whatever the warehousing business. These are the three things that comes under the total income. And for the deduction under section 80C and 80D, 80D he will get deduction of 22,500, and 80D will get deduction of 1,50,000. I'll repeat, how did he get for 80D? Very, very simple. 90,000 is the premium which he has paid for 4 financial year, starting from 23, 24, 24, 25, 25, 26, 26, 27. 36 months total he has paid. It goes for 4 financial year, and this 4 financial year I've taken the premium calculation for 4 years in total, and 22,500 is the amount. This is the deduction which is available. However, ATC up to 1,50,000 is allowed under section 80 CCE, being the maximum permissible limit. Clear? Great. Now let's look into how the calculation happens. First of all, this fellow is having an income of 80,000 rupees from the XYZ Private Limited. No, 80,000 per month multiplied by 6 months. And he will get a standard deduction of how much? 50,000. What is this? This is going to be the standard deduction of 50,000, 4,30,000. Clear? PGPP, in this case of PGPP, he has 110, that is the 35 AD profit. Out of that, deduction allowed as 60 lakh. So total, how much is his income? Profit 50 lakh. But in case of salary from firm, please try to understand a point wherein whenever you are calculating the salary from the firm, people, whenever you are calculating what? Whenever you are calculating salary from the firm, first of all, salary received by the partners from the firm is exempted in the hands of the partner. It's not taxable. Sorry. It is going to be taxable. The profits is not going to be taxable received by the partners from the partnership firm, but the salary is going to be taxable, normally speaking. Correct? See, what will happen is very simple. Suppose the partnership firm has earned some profit of 10 lakh rupees. On this one, the firm itself pays the tax of suppose 3 lakh, 30% being the point. The firm itself pays 3 lakh rupees tax, and the remaining 7 lakh rupees, whatever they have, this will be divided among the partner A and B, 3.5, 3.5 in my exam. Clear? Can I say whatever the profits which this A and B partners are getting, this is after setting off the taxes, then they are getting the amount. Hence, whenever the profit being received by the partners, it is not going to be taxable in the hands of the partners because it's already taxed in the hands of the firm. But what will happen in case of this salary? No, pay close attention. Let's consider 10 is the income of the partnership firm. Salary which is given to the partners, let's consider it is 4. So how much is the profit? Profit is 6. Now this 6, they will pay the tax for this 6. Keeping, let's consider 1 lakh is the tax. Just an example. 1 lakh is the tax which they have paid, and remaining is 5 lakh. This 5 lakh will be apportioned between A and B as 2.5, 2.5. Just try to understand the example. Don't look into the numbers very much. What does it mean? It means that partnership firm has not paid the tax for this 4 whichever you have deducted, which is already debited to P&L. For the remaining they have paid. 2.5 is received by A. It is not taxable because the profit, it's already taxed in the hands of the firm, and it is not taxable. But what about salary? Salary should be taxed, no? Salary is something that is supposed to be taxed in the hands of the partners. Because it is not taxed in the hands of the firm, A receives 2 lakh rupees as the A receives 2 lakh rupees as what? 2 lakh rupees as his income, has his salary, and his salary will be taxed in the hands of A because it is not taxable in the hands of the firm. In this case, what will happen for Mr. Ganesh? Try to understand something. The profit of 10, let's consider it is for two partners, A and B, 2 and 2. If I'm speaking about the partnership over here the profits are disallowed. To the extent of 2, it is disallowed. Let's consider the salary which has been debited in the P&L account and the profit which you have considered as per your P&L is 6. Now this 6 becomes the starting point in the calculation of your PGPP. Now I'm going to disallow 2. I'm going to disallow the remuneration which is paid to Mr. Ganesh in my example suppose. So I'm going to add back. Now the partnership firm's net profit, that is PGPP income, would be 8. What does it mean? The partnership firm is already paying tax for the remuneration or the salary which is given to Mr. Ganesh. Understanding for remuneration of the salary which is already paid to Mr. Ganesh, the firm already paid it. So what Mr. Ganesh will do? Mr. Ganesh, will he pay it again? No, Mr. Ganesh will not pay it again. Hence the salary from the firm which is not taxable in the hands of the partner because it's already taxed in the hands of the firm, it is not going to be considered as the income of Mr. Ganesh because it's already taxed in the hands of the firm. Clear? So the total income would be so much, out of gross total income would be so much, and out of that 80D deduction you have already discussed 22,500 minus ATC 1,50,000, your total income would be 52,57,500, which is nothing but your option A. Which is nothing but your option A. Clear? I hope it is clear. Let's go. Very good. What is the tax liability of Mr. Ganesh under the default tax regime under section 115 BAC for AY 24-25? What is the tax liability of Mr. Ganesh under default tax regime? First of all, if you are speaking about our default tax regime, 115 BAC, you will not get 10AA. You will not get ATC to ATU except certain three deduction. You will not get 10AA. You will not get 35 AD. You will not get anything. So how you would do the calculation is very simple. Whatever you have calculated over here, no, this itself becomes the starting point, people. That is the net total income as per the normal provisions. Now, whatever is disallowed, whatever is not considered under 115 BACS deduction, you will add back all those things. That is ATD and ATC you have allowed as deduction, that you will add back. 35 AD, to this extent of 35 AD, how much is the deduction which is allowed? 60 lakh, no? That 60 lakh is added back. Now, if you are not allowed the deduction for the capital expenditure under section 35 AD, if that was the case, you would have normally provided the deduction of people. You would have normally provided what? You would have normally provided the deduction. So what is the deduction? Normally provided deduction would be 60 lakh. 60 lakh into 10% because that was building, warehouse construction. That was for warehouse construction. See, capital expenditure in respect of warehouse is 90 lakh including the cost of land. So 60 lakh is building only, you can assume that easily. There's a small catch over here. See, this became operational from 1st December 2023. Means the asset has been put to use as per the income tax from 1st December, which means it is put to use for a period less than 180 days. Beautiful point, people here. It has put to, these are the small, trickiest thing which they can bring in. 180 days, less than 180 days you have put to use. So what does it mean? It means you have to take only 50% of the allowable depreciation. 50% of the allowable depreciation means 60 lakh into 10% into 50%, 3 lakh would be depreciation that you are going to consider. And then after doing this, the entire total income would be so much. And how would you calculate your tax liability? Would be your tax liability calculation goes in this way. That is, you will do. I hope all of us know the tax liability computation. Hence, I have not written it in a very greater sense. Up till 3 lakh, nil, 3 lakh to 6 lakh, 5%, 10%, 15%, 20%, 30% on the remaining. I hope all of you know this tax liability calculation. So I have written it very simple. In total 30 lakh 39,000. And you will add surcharge of 15%. Why surcharge of 15? Because people, its total income is greater than 1 crore. No, if it is greater than 1 crore, it is going to be the surcharge which is applicable would be 15%. So 15% of the surcharge is 4,55,850. I hope it is clear. 4,55,850. This is the point. And total you would consider so much. And HEC at how much? HEC at 4%. HEC at 4% would be considered for the purpose of calculation. HEC at how much? HEC at the 4%. HEC at 4%. You would take the HEC at the 4% and tax liability you would calculate so much. So option C would be your answer. Option C. Clear? Great. Next question. What is the tax liability rounded off of Mr. Ganesh if he has opted out of default tax regime, which means they're asking the tax liability for the noble profession. Arey, you already have the total income calculation over here, no? You already have the total income calculation over here. So what you would do, total income which you have already computed in point number 3, you would take the total tax liability and you would consider the same. You would add surcharge of 10% because it is greater than 50 lakh but less than or equal to 1 crore. Surcharge applicable is 10%. And if you want the more information about the surcharge, separate videos there, you can go and watch over there. And 4% of HEC and the tax liability is 15 lakh 87,000, 89,870. See here, the 15 lakh 89,870 people. But the answer is not this. Whenever you're considering the default tax regime, whenever you're considering the opting out of default tax regime, nothing but the normal provision, Govinda, you should consider AMT also. This question is very tricky and very good question here. They have considered AMT here as well. Alternate minimum tax which you need to compute for your individual, which is taxable on the book profit of 18.5%. How much is it? How much? How much? How much? How much? 18.5%. Govinda, please here. Net profit as per the total income is so much. And as per AMT, the deduction under section 35A is not available. Deduction available under section 35A is not available. So now we are going to add back the deduction and now we are going to give the depreciation under section 32. Because if the deduction, if you wouldn't provide 100%, you would get the depreciation. Similar depreciation has been considered and you have got your total income. And tax would be considered at the rate of 18.5% on the book profit. And the surcharge, however, it would be the same thing. Income exceeding 1 crore, surcharge applicable would be 15%, so much. And HEC would be 4%. And Govinda, your answer is option B. That is 24 lakh. That is 24 lakh 24,460. Very, very good question, people. So the next question, question number 6, where Mr. Akshay, age 59 years, an Indian citizen, traveled frequently out of India, very well for his business trip as well as for his outing. He left India from Delhi airport on 20th April and returned on 15th October 2023. And he has been in period less than 700 days during the last seven PY, which means preceding the preceding the previous year. Determine his residential status and his total income for AY 24-25 from the following information. Okay, first we have to determine the total income also and we have to determine the residential status also. Residential status can be determined with so much information. So first of all, this fellow, he left India from Delhi airport on 20th April and then returned on 15th October 2023. So for how many days? Basically, in order to calculate what is the basic condition that you need to consider is that one, he has stayed in India for 182 days or more, or he has stayed for last 4 PY for the period of 365 days or more, and he should have stayed at least 60 days in the relevant PY. If he has satisfied any one condition, he would satisfy the basic condition. See, let's look into it. The basic condition, he has stayed for 189 days, starting from, that is, he has left on 20th April 2023 and returned on 15th October 2023 to India. No? In between the days, if you calculate, you will get 189 days. Just to take the math and how many days he has stayed in India and calculate, and you will get how many days? You will get 189 days. Okay. And as he was there in India for 189 days, he would be considered as resident. But in order to state whether it's ROR or RNOR, you have to look into additional condition. Additional condition, how do you determine the additional condition is very simple. Whether he has been a resident in India for 2 out of last 10 years, or he has been in India, or he has stayed in India for a period of 730 days or more in the last 7 PY. Any one condition satisfied, he would not anyone, both the conditions satisfied, he would become ROR, otherwise he would become RNOR. So here, as he stayed for a period less than 700 days in the last 7 PY, he is not eligible, he cannot be called as ROR because he doesn't satisfy both the condition. He would be called as RNOR. He would be called as what? He would be called as resident but not ordinary resident. And now when it comes to the computation of total income, as is RNOR, you have to look into the taxability of RNOR. How is it? Indian income taxable for RNOR. Foreign income where the business is established and controlled, set up in India, taxable. Other foreign income not taxable. These are the 3 points that you need to remember. The long-term capital gain on sale of shares of Sharma India Limited amounting to 1,12,000. The sale proceeds were credited to his bank account in UK. As per the deemed to be accrued or arised concept, section 9, subsection 1, clause 4, the dividend income which is paid by the Indian company would be fully taxable. It would be deemed to be accrued or arised in India, and hence the long-term capital gain of whatever he has earned, it would be taxable in India. Now, dividend amounting to 40,000 in total received from RIL Indian company. He had borrowed from Mr. Abhay, a non-resident Indian, for the above investment on 2nd April 2023. Interest on the borrowed money for the PY 23-24 amounted to 10,000. So, what does it mean? 40,000 is the gross amount from RIL that he has received as the dividend. Okay, 40,000 is taxable. But under section 57, income from other sources, you have a deduction that would be allowed. That is the interest expenses or 20% of the dividend amount, whichever is lower, would be allowed as deduction. So, how much is the interest on the borrowed capital this fellow is paying? 10,000. 10,000 rupees or 20%. 20% of this 40 lakh. How much is it, people? 20% of 40 lakh. 40,000 into 20%. This would result in 8,000. 8,000 or 10,000, whichever is lower, 8,000 will be allowed as a deduction. See, 40,000, 10,000. This amount or 10,000 rupees, 8,000 is allowed as deduction. 32,000 becomes taxable. Next point. Interest from the post office savings account 9,500. In post office savings account, you have two things. One, you will get exemption of 3,500 rupees exemption, and then you will get deduction under section 80 TTA. So, first of all, you will get deduction exemption of 3,500 under section 1015, 6,000, and then after adding everything, you will get GTI of 1,50,000. Then you will get 80 TTA up to 10,000 rupees. 80 TTA where you will get if you're having interest from savings bank, if you're having interest from post office and cooperative society savings account, you will get a deduction up to 10,000. So 9,500 out of this 3,500 is exemption. The income part included in GTA 6,000. So 6,000 rupees is allowed as deduction under your total income 1,44,000. I hope it is clear. Okay. So let's move forward with the next question. See here all these things. The notes of whatever you could see, it is available in my Telegram channel. You can go join and get the free resources. Okay. Mr. Rohan, an employee of ABC Limited, is posted at Mumbai. He was appointed on 1st March 2023 on the scale of 60,000, 2,000 and 80,000. Details of his other income for the previous year 23-24 are as follows. DA 40% of the basic salary, 60% forms part of retirement benefit, telephone allowance is given, PF information is given, company contributed RFA is given, and all the other things are given. We'll go one by one. What is asked? Determine the GTI for AY 24-25 under normal provisions. Please remember whether they have asked for 115 BAC or whether they have asked for the normal provisions. Please remember and answer that. Okay, let's move forward. Mr. Rohan, this fellow is an employee. He was appointed on 1st March 2023 on the scale of 60,000, 2,000, 80,000. What does this point mean? 60,000, 2,000 and 8,000. Try to understand. Okay. 60,000, 2,000 and 8,000 means he has started his salary from 60,000 Right from 1st March 2023, he is getting 60,000. Entirely 12 months, exactly after completion of 12 months from the date of joining, he would be increased with this 2,000 until and unless his salary gets to 80,000. That is what it means. So from 1st March 2023 to 1st March, that is to 1st 29th of February or 28th of February, 29th or 28th of February 2024, he would be getting for this 12 months, he would be getting how much? 60,000. And from 1st March 2024 to 29th of to to 29th of Feb to 29th of Feb 2024, he would be getting how much? He would be getting 29th of 24, he would be getting how much? 60 plus 2000, 62,000. So what is the point that is important to us is our PY which we are concerned is 23, 24. No. So this PY which we are concerned with 23, 24, it starts with 1st April 2023 to 31st March 2024, wherein as per the understanding which we have, from 1st April 2023 to 29th of Feb 2024, what salary I would be getting is 60,000 plus on 1/3/2024, what salary I would be getting is 62,000. This is 60,000 into 11 months, and this is going to be plus 62,000 into 1 month. This would become my total basic salary for that matter. I hope everyone have understood what we have done. Clear? See, what we have done is very, very simple. 60,000 into 11 months and 62,000 into 1. How did you get? We have understood. Right from this date to this date, we are earning 60,000, and right from this date to this date, we are earning 62,000. I hope this is clear. I hope this is clear, everyone. So I'll just put this as a note only so that it will be easy for your quick reference or your understanding. This is working note 1. No, I'll just add this as working note 2 for your cross reference so that if you want to refer, you refer it in a next cases. Okay, great. So I hope everyone are understanding what we are doing. We will. Great. So let's continue with our understanding people. So this here it is going to be 62,000, and here it is going to be 60,000 for one. Great. So now this is how we have calculated 60,000 into 11 months and so much. I'll just write working note 2 for your cross reference. Okay, we'll move forward. DA, other information, other income information is provided. DA, 40% of the basic salary, 60% forms part of the pay for retirement benefits. So it means 40% of the basic salary. How much is my basic salary? 7,22,000. 40% of this leads to the retirement, that is leads to basic DA. 60% forms of part of this total, that is out of the total DA. 60% forms part of the retirement benefit. So this is going to be DA in terms which is going to be useful going forward. For the purpose of salary calculation, you will get into HRA and all. No? Over there, it is going to be useful. Very well, fine. Let's move forward. Telephone allowance is 500 per month. Telephone allowance is going to be fully taxable, people. Telephone facility under purpose, it is exempted, but telephone allowance fully taxable. So 500 per month into 12. 500 per month into 12, whatever the amount that you would get, 6,000 rupees, this would become taxable as telephone allowance. So telephone allowance 500 into 12, 6,000 becomes taxable. Great. Next point. Both Mr. Rohan and the company contributes 15% of the basic salary to RPF, and interest uh, accrued in this fund is 12%. Interest accrued in this fund is how much? 12% per annum amounted to 25,800. First of all, when you're contributing to RPF, up to 12% is going to be exempted. Whatever employer contributing, up to 12% exempted. Beyond that, it is going to be taxable. And interest accrued at 9 up to 9.5%, it is going to be what? Up to 9.5%, it is going to be exempted. It is going to be exempted. But what about 15%? Up to 12%, it is going to be exempted. Clear? Beyond that, it is going to be taxable. So if you are considering the same over here, that is employer contributing. How much is that? 15% is what is contributing on the basic salary mentioned in the question. So it is going to be 7,22,000 basic salary multiplied by 15%, 1,08,300. 12% of the salary is the exemption. But as per income tax, 12% of the salary means salary definition for the RPF would be basic plus DA in terms. Basic plus DA in terms. Correct. So basic is 7,22,000 plus total DA is mentioned 2,88,800, but DA in terms is only 60% of that. No? So out of this total, 12% is something which is going to be exempted. So 12,000 of the same is going to be 1,07,434, 866 would become taxable. Interest accrued at the rate of 12% is going to be how much? That is, first of all, interest accrued is 12%, 25,800. People remember, if 25,800 is representing 12% of the interest, how much is 9% of interest pertaining to cross multiplication? If you do, you will get the answer. 25,800 is representing 12. How much is 9.5? 20,425, which is exempted. The excess of that amount is going to be taxable. Clear? Great. Next. The next point would be the company has provided him with the RFA in Mumbai owned by the company. If it is owned by the company and if it is provided in Mumbai, obviously it is going to be population higher than 40 lakh. So it is going to be 10%, that is what you will consider, and that is the amendment which we have in PY 23-24. Up till from 1/9/2023, the RFA that you need to consider is 10%. Beyond that, from 1st April 2023, 31st of 8 2023, it is going to be how much? 15%. And for the remaining months, it is going to be 10%. That is from 1st April to August, it is going to be 15%. So how you are going to consider or calculate the RFA is going to be very simple. This is 60,000 is for 5 months. Basic. See, first of all, how do you compute RFA, people? Basic salary for the purpose of RFA would be basic plus DA in terms plus all the taxable allowances. No purpose it's are considered. So it is going to be the basic plus DA plus telephone allowance. The total is coming up to 3,74,500. 15% of that is so much. And similarly, from September to March, 10% of the amount, the calculation would be so much. 60, this is going to be for 6 months and this is going to be for 1 month, 7 months. 5 months is considered here, 7 months is considered here. Total is 12, no. So, 12 months. This is going to be for the remaining 60% of whatever the DA we are supposed to consider. And then it is going to be 5,000 into 7, which is nothing but your calculation. The total calculation has been considered. I hope it is clear. Done? Okay. So after doing the calculations for that matter, 56,175 and 52,678, the total is coming up to how much? The total is coming up to 1,08,853. Clear? Now, the salary of 2,500 of the domestic service is reimbursed by the company. Whenever the reimbursement of the domestic servant happens, it is going to be fully taxable in case of specified employees. So 2,500 per month into 12 is going to be fully taxable. Clear? Rohan has used his own car 1.8 liter per engine capacity, which means it is above 1.6 cc, 1.6,600 cc for both official and personal purpose. This is for POPP, person for professional purpose, partly for business purpose and partly for professional purpose also. The running and the maintenance cost of 50,000 are borne by the company. So what is the total benefit which the employee gets is that he will not get any benefit with regarding to the motor car because he owns the motor car. 50,000 is the benefit which he would get, and he uses both for his official purpose and personal purpose. So what he would do, 50,000 is his cost, plus minus he will get certain relief, that is 2,400 based on the engine capacity. For 12 months he will get the relief because it is his own car, and 21,200 is what you would consider. Clear? Okay. People, all these concepts are done. We are just coming up with all the provisions at once and solving the question. So please remember, if you feel some clarifications need to be provided in depth with regarding to certain concepts, there are other videos explaining the motor car purpose at HRA, everything separately. You can go and watch over there, and we are sticking with the RTP. Okay, remember, very well, fast. Professional tax paid 2,500, out of which 1,500 was paid by employer. See, professional tax can be paid either by employee or either by employer. Whatever is paid by employee is going to be allowed as deduction, standard deduction. So you are going to get the professional tax as the deduction. Very well. Fine. Whatever the employer has paid, no, whatever this fellow, out of this 2,500, employer paid 1,500, remaining paid by employee. So this 1,500, whatever is paid by the employer, very simple. You just have to add that to your income first, because that's the income which you are getting. Then we have to take the deduction of the entire 2,500. So 1,500 you are going to take the deduction, people. 1,500. First of all, you are going to add, and then you are going to take the professional tax 2,500 as the deduction. Clear? During the year, Mr. Mohan gifted a sum of 6 lakh to Mrs. Rohan, to his wife. She started a business by introducing such amount, and total investment in the business was 10 lakh. So our total investment was 10 lakh. He invested 6 lakh. So 60% is pertaining to him. Whatever the profits he gets, up to the extent of 60% would be taxable in his hands. So under the head PGBP, 1,20,000, is he getting profit or is he getting loss? She is getting loss. So out of that, she can carry forward. Mr. Mohan will be eligible to get the loss also. So 1,20,000 into 60%, he will get how much? 72,000. This will be carried forward to the next assessment year. Why it can't be set it off? Because PGBP income can never be set it off. PGBP losses can never be set it off against the income from salary. Remember. Okay. So gross salary of computed, standard deduction of up to 50,000 would be provided, and then tax paid employer is provided, and then taxable salary, you got your GTI. What have they asked? Have they asked NTI or GTI? They've just asked GTI in this question. Okay. So question number 8, that is Mr. Mayank, a resident individual, furnished the following information in respect of the income which is earned and on the income or the losses which have been incurred by him for the FY 23-24. Okay. Income from salary, 27 lakh 40,000. A loss, that is long term capital gain, loss on sale of shares of the Reliance Limited, 1 lakh 25,000. Income from let out property in Kanpur, loss from let out property, and interest on self occupied property in Mumbai is given, winning from lottery and winnings. Fine. PGBP, that is profits and gains from business or profession after deducting normal depreciation 2 lakh and additional depreciation 58,000. Profit is smooth. Other details, unabsorbed depreciation, business loss is given, unabsorbed depreciation is given, loss from owning and maintaining the resource is given, and loss from letting out the property in Delhi is given. This fellow, Mr. Mayank, filed his return for AY 23-24 on 28/7/2023 and opted for 115 PAC. It means in the previous PY, in the preceding pre-Y, he has opted for 115 BAC. So, and what have they asked? Compute the GTI for AY 24-25 and loss, if any, he wants to continue with the provisions of 115 BAC. He wants to continue as per the provisions of 115 BAC only. So, let's see how we can compute this. First of all, when it comes to 115 BAC, remember all the provisions with regarding to set off and carry forward is same as that of normal provision except one, that is if there is any losses from carry forwarded from your If there is any losses of income from house property, that cannot be set off. That is, internet adjustment can't happen. If it is a normal provision, internet adjustment up to 2 lakh rupees could have happened, but here in this case, internet adjustment can't happen. Clear? Internet adjustment of income from house property, that is loss from house property, cannot be set it off against any other head. There is no cap of 2 lakh also, nothing can be set it off. That's the one. Okay. When it comes to loss from house property, and first of all, let's go one by one. You have first of all, you have income from salary, correct? And you have long term capital loss. All of us know the long term capital loss can be set it off against gain from long term capital, that is long term capital gain. Capital loss, long term capital loss can be set it off only against long term capital gain. So this 1,25,000, as there is no other long term capital gain, we have to carry forward this loss for 8 assessment year. When it comes to income from let out property in Kanpur, first of all, you have some income, and then you have loss that can be set it off, and you have this. Remember, as we are doing 115 BSc, there is one more point, that is interest on self occupied property. Interest on self occupied property can't be set it off. That is, there is no such deduction which is allowed in case of interest on self occupied property. In case of normal provisions, yes, that is allowed up to 2 lakh rupees based on the condition satisfied. But in case of 115 BSc, that's not possible. So this interest on self-occupied property can't be set off. So how? See, income from salary computation you have recorded, income from house property, income from Kanpur. Set off. As usual, you can set off the loss from the other house property within the same head. Yes. Interest under section 24B, it is not allowed because as you are doing this in 115 BSc, and whatever the loss from the let out property in Delhi, you can't have, that is, you can't make any interest adjustment also, and the carry forward of the losses are a last year loss, no 115 BAC. You can't carry forward those loss here. You can't do interhead adjustment. You can't do intersource adjustment. That is loss from the LOP property in Delhi. You can't set off the same from the head income from house property. Carry forward of the losses of the income from house property can't be set it off. Clear? Apart from that, all the other income, that is income from PGBP, whatever the PGBP income you have, under 115 BSc, normal depreciation is allowed as deduction, but under your additional depreciation, you can't set off the additional depreciation. That is, additional depreciation is not allowed as deduction under your 115 BSc, that is in your default tax regime. Clear? So additional depreciation, but in this case, what has happened? This 36 lakh 86,000, whatever is given, is after normal depreciation and additional depreciation. Is normal depreciation allowed to be allowed as deduction under your normal provision? Yes, absolutely. What about the additional depreciation? Is it possible? No. Additional depreciation, as they have already given the effect, it has reduced my profit. In order to give the proper effect, I'm adding it back in my solution. That is 50,000. I'm adding. Then, whatever the losses which you have, do you have any other business loss here set off? No. Do you have some carry forward losses? No. That is, you have some business loss 5,35,000 that I will set off first. Then you have some unabsorbed depreciation. Unabsorbed depreciation can be set off against any head, against any that is against any head apart from salary. So 2,10,000, and also that is given the last priority 2,10,000 you have considered. After doing all the math, you will get your PGPP. Clear? Long-term capital loss is set it off. Sorry, long-term capital loss is carry forwarded. And net winnings from the online games, if you can see, this net winnings from online games, net of TDS. Net of TDS amount is 35,000. But we have to do the grossing up over here, no? So 35,000 is representing your 70%. How much is my 150,000? So my GTI would be 59 lakh 56,000. The loss which have been carry forwarded to A by 2526 is the business loss of 1 lakh 50,000 and long-term capital loss of 1,25,000. Clear? Next question. Question number 9. Examine the applicability of the TDS or tax collection at source as per the income tax for AY 24-25. Great. Mr. Arjun, a resident individual, is in retail business in Delhi and his turnover for FY 22-23 was 9.9 crore. He regularly purchases goods from another resident, Mr. Saurabh, a wholesaler in Noida. GST rate on such is 5%. The aggregate amount of sales by Mr. Saurabh to Arjun is 49 lakh. And Mr. Arjun made the payment for consideration of goods 21 lakh plus 26 lakh 25,000 plus 4.2 lakh on 11/3/2024. Mr. Saurabh's turnover for FI was 10.10 crores. See here, first of all, try to understand Arjun is the buyer. Arjun is the buyer and uh, Saurabh is the seller. In order for 194Q to be applicable, first of all, the buyer's turnover should exceed 10 crore and the purchase that should have happened should be excess of 50 lakh rupees. Only then 194Q is applicable. See, Arjun's turnover is 9.9 crore, which means it is not exceeding 10 crore. 194Q is not at all applicable over here. But however, 206C1H is applicable, TCS provision is applicable as the turnover of the seller is exceeding 10 crore. And these tax that would be applicable is 0.1% on excess of 50 lakh rupees. On excess of 50 lakh. See, what is the total payment made here? 21 lakh plus 26.25 plus 4.2. Excess of, if you add all these three, how much would you get? Please add everyone. Excess of 21 plus 26.25 plus 4.2. How much would you get? 51.45, which is excess of 50 lakh would be 1.45. On this one, on 1.45 lakh, 0.1% you're going to add. If you continue to calculate, you will get 145 rupees as the TCS that need to be collected. Clear? That is 145 rupees is the TCS that you're supposed to collect. Clear? Done. Mr. Raju paid 12 lakh rupees on 1/11/2023 Thomas Cook for a holiday package to Singapore for a week with his family. Okay, this is tour package which comes in your TCS. 12 lakh rupees he paid. And Mr. Raju also remitted 10 lakh on 28/3/2024 out of his personal savings under LRS as a gift to the sister residing in London on the occasion of 50th birthday. On the occasion of her 50th birthday. So in this case, please understand Mr. Raju paid 12 lakh. Total, how much did he pay? 12 lakh he paid plus he paid how much? 10 lakh. Total he paid is 22 lakh. So now let's look into the point one by one. See here, this Thomas Cook, this person being the seller of the this overseas package, he has to collect the TCS under 206C1G. Mr. Raja, on receiving the amount for purchase of the package, the amount received and up to how much he has received? He has received 12 lakh rupees. No, so up to 7 lakh, the TCS that is applicable is 5%, and excess of 7 lakh, the TCS applicable is 20%. So up to 7 lakh, he is paying 35,000, that is 5 lakh into 7, 7 lakh into 5%. On the excess of that, he has paid total of 12 lakh. No, so 5 lakh into 20%, 1 lakh. So total TCS that is supposed to be collected is 1,35,000. Through the bank, as he is sending it as a gift, how it will be applicable is that 206C1G, that is at the rate of 20% on excess of 7 lakh rupees. No, this person has however paid 7, this person however has paid more than 7 lakh rupees. Since the remittance of 10 lakh rupees is not for the purpose of education and treatment, Bank of India has to collect TCS of 20% of 3 lakh rupees being the amount remitted in excess of 7 lakh. Up to 7 lakh rupees, there would be no tax. Excess of 7 lakh, they have to collect directly 20%. Clear? Great. Mr. Ramesh is an authorized wholesale distributor of fertilizers and other agricultural products, and analysis of his trading and profit and loss account for the previous year, 31st March 2024. This revealed the following. Net profit is so much. The following incomes which is credited in P&L. See, rent plus rent P&L, for P&L these amounts are credited. But remember, rent received is taxable under the income from house property. Income from income tax refund, interest on this would be taxable under the head income from other sources, but income tax refund as such is not applicable for tax. Dividend from Indian company, this is applicable for tax under the head income from other sources. Rents and taxes debited to P&L account include 1000 rupees paid towards the late fee of IT return under 234F of the Income Tax Act. Salaries which is debited to P&L account amount to 35,000 on a single day, and they have given interest information, municipal tax information. Will go one by one in a very detailed manner. See, try to understand, this fellow is an authorized dealer of fertilizers. They have given profit and loss after doing all the computation. Net profit is so much. So whenever I'm starting my solution, my net profit, whenever I'm starting my solution, my net profit would be resulting in so much. Fine. Now, the rent receipt they have given in the question, two adjustments need to be done. Rent received, which is already credited in the P&L account, this need to be taxed. This is the income which is taxable, but not under PGPP, but under different head. But in PGPP, they have already given the effect, no? So what has happened? Rent received, its income increase. Income increase would have resulted in profit increase. Now we have to give the reverse effect. So income decrease, which is nothing but you have to subtract this in PGPP, and you have to show this as income in income from house property. That is what you should do. Clear? Similarly, income tax refund, it is not taxable at all. Income tax you're paying is not allowed as deduction, hence income tax refund is not subject to tax, but interest on income tax is going to be, income tax refund is subject to tax, but here it's just income tax refund. So what I will do, I will subtract this from my PGPP. Clear? Dividend from Indian companies, this is going to be removed. This is not taxable under the head PGPP, but it is taxable under the head income from other sources. So what I'm going to do is very simple. I'm going to reduce this income from, that is, I'm going to reduce the rent receipt. Whatever the portion is, I'm going to remove this rent receipt, subtract rent receipt, income tax refund, and dividend receipt. And income receipt will be taxable under the head income from house property. And in other sources, I'm going to add interest on income tax refund, which is provided later. That will provide dividend. I am provided in the income from other sources as usual. Two effect. Please give the two effects simultaneously. Clear? Rates and taxes debited to profit and loss account. Rates and taxes debited to profit and loss account include 1,000 paid towards the late filing of IT return. People, first of all, remember any income tax related taxes you are paying, and this is the penalty which is being paid. All these things have should be disallowed. It is going to be disallowed. Any income tax related information you have paid, it is going to be disallowed under the head your PGPP. So if it is disallowed, what you will do? You will add back. No, people, more explanation about the PGBP. There's a separate video which has been given a detailed explanation in a revision form. You can go and watch over there. But remember, this is going to be disallowed. Not allowed means disallowed. Late filing, disallowed. Disallowed means the expenses which are not allowed. Expenses which are allowed would have decreased your profit. If it is disallowed, it should be given the reverse effect. That is, it should be added back. Clear? Done. Salaries debited to P&L account include 35,000 paid on a single day by cash. People, cash disallowance, section 40A3, which lead to cash disallowance. Any amount, any expenditure, any payments that you have made in excess of 10,000 rupees, other than account pay check, account pay draft, or any other clearance mode per day to one person, it is going to be disallowed. So 35,000 cash disallowance of 35,000. This is going to be added back. Clear? Done. Next. Interest of 1,20,000 paid on loan of 10,000 taken from NBFC. Out of the loan, amount of 2 lakh was used for personal purpose and the balance was used for business purpose. No TDS was deducted while paying interest. Interest of 1,20,000 is debited to P&L. First of all, amount of, out of this 10 lakh rupees loan, 2 lakh rupees was used for personal purpose. So personal purpose expenses should be disallowed. No. So what I will do is very simple. 1,20,000. If this 1,20,000 is interest for 10 lakh, how much is it for 2 lakh? I'm going to disallow the same. To the extent of 24,000 out of 1,20,000 is disallowed. Clear? And here this fellow has not deducted the TDS also, which was supposed to be deducted. So section under section 40A IA 1A, disallowance of 30% would be considered. That is, you are going to disallow 28,800. So how did you get this 28,800 over here? Is very simple. Out of 1.2 lakh, 24,000 is disallowed. So 96,000 would be the amount. Out of this, 30% is disallowed, which results in 28,800. Clear? I hope it is clear. See, next point, people. Municipal taxes paid 10,000 rupees for the building was debited to P&L. First of all, municipal taxes is allowed as deduction under the head income from house property, but not under your PGBP. Correct? So this is considered as expenses. This expenses should be disallowed and should be given as expenses deduction under the head income from house property. So what you will do is very simple. Under the head House property will provide the deduction of this whatever 10,000 rupees which he has paid for the building was debited to the municipal taxes. And see, half of the building is used for business purpose and remaining half is let out for residential purpose. So only to that extent of 50% of that amount is allowed as deduction. I'll write over here. How did you get this one? 10,000 into 50% is allowed taken for residential purpose and 50% is considered for your business purpose. That is for your other purpose. Half of the houses building is used for business purpose and remaining half is let out for Mr. Anshul for residential purpose. So Mr. Anshul residential purpose, you've just let it out. You could have given it for anyone for any purpose. You've let it out. No, so 50% is allowed as deduction. And for the municipal taxes, whatever you're considering, the entire 5,000 is considered as your deduction. Clear? Municipal taxes to that extent, whatever you considered, you have considered it as deduction. Simple. Next. Closing stock was undervalued by 40,000. People remember. The closing stock is undervalued by 40,000. What does it mean? You have shown your closing stock less by 40,000. If closing stock decreases, your profit would have also decreased. Now we have to give the proper effect by adding closing stock. So closing stock increases, your profit also increases. So what would be the effect? The closing stock you should increase means profit also you should increase. What is the effect it has on profit? Profit increase. So what you should do is that you should add the undervaluation of the stock to that extent of 40,000. Clear? Income tax refund relates 2,000 towards the interest. So this interest should be considered as taxability under the head income from other sources. So dividend, so interest on income tax refund 2,000 rupees is added under the head income from other sources. The whatever the question which you are seeing, the notes for that is available in my Telegram channel. You can go and get the free resources. Amount of 45,000 was paid by check during the year towards health insurance covering himself, his spouse and his children. So with regarding to this one, how much is the deduction that is going to be allowed under section 80D for this fellow? Under section 80D, it is restricted to 25,000. 45,000 he might have paid, but it is only available to the extent of 25,000. So up to 25,000, this fellow can get the deduction. Up to 25,000, this fellow can get the deduction. Clear? Advance tax paid during the year is 15 lakh rupees. How much is the advance tax that has been paid, people? Advance tax paid is during the year is 15 lakh rupees. What does it mean? The advance tax, when you're doing the computation, you will reduce the advance tax, whatever amount which has been paid. Clear? So you're required to compute the total income and the tax payable. Now, when you're doing the tax computation, this point of advance tax will come into picture. So this point is considered. He also sold his vacant land on 10/11/2023 for 10 lakh. The stamp duty value of that property was 14 lakh. The fair market value in the stamp duty value as on 1st April 2001 was 4 lakh and 3 lakh. This land was acquired by him on 5/8/1995 for 1.8 lakh. The cost of the property, which was purchased before 1/4/2001, was 1.8 lakh. This is cost of acquisition. But the fair market value of the property as on this one and stamp duty value. This is the fair market value and this is the stamp duty value as on what date? As on 1st April 2001 is so much. He had acquired registration expenses of 10,000 at that point of time. So you would add 10,000 rupees to this one for the cost of acquisition. So the cost inflation index on 23-24 and 21-22 is so much. They are given the information to this extent. So try to understand one point very clearly, people. See, when it comes to your cost of acquisition determination, how you're going to consider is that in case of land or building, you have STV provided. Cost of acquisition or the fair market value of land as on 1/4/2001. Before that, you're going to do another step. That is, you're going to consider the fair market value and the SDV as on so much as on 1/4/2001. You will see whichever is lower, 3 lakh rupees is lower. 3 lakh rupees would be considered as the fair market value over there. And 3 lakh rupees and 1.9 lakh rupee, 1.8 plus 10,000, 1.9 lakh would be considered. Out of these two amount, whichever is higher would be considered as the cost of acquisition. So my cost of acquisition becomes 3 lakh. Based on this 3 lakh rupees, so CII would be considered. CII as on the year of transfer would be considered as the numerator. CII on the year of purchase or 2001 and 2, whichever is later would be considered as the denominator CII, and you would get the cost indexed cost of acquisition over here. Very well, simple, no problem at all. And one more small point which you need to consider is that when you're selling the property, so this property has been sold for the consideration is 10 lakh. The stamp duty value is 14 lakh. If your consideration is, if your SDV is in excess of 110% of the consideration, then SDV would become your full value of consideration. As consideration is 10 lakh and stamp duty value is 14 lakh, as it is exceeding 110% of the consideration. How much would you get here? 110% of the consideration. Please do the math. 10 lakh into 110%, you would get 11 lakh. As this is exceeding 11 lakh rupees, you are going to consider the SDV as your full value of consideration. Then you are going to do the calculation 14 lakh minus 10 lakh 44,000, and the stamp capital gain would be so much. 3 lakh 56,000. I hope everyone have understood. Okay, great. So then deduction under section 80D, you would get the GTI of so much after adding the income from house property, after adding income from house property, after doing all the calculations of the PGPP, after doing the capital gain calculation, and after doing the income from other sources totals. After doing everything, you will get GTI. Then deduction in the chapter 6A, you will have 25,000. It is what you have provided. When you're doing the income tax computation, please do remember, under for your long-term capital gain, it would be taxable at the rate of 20%. So long-term capital gain is taxable at so much. On the balance, you're going to do the computation as usual, and you would get, as your income is exceeding 50 lakh rupees but less than or equal to 1 crore, the surcharge that would be applicable is so much. HEC will add, this becomes your total tax liability, and whatever the advance tax you have paid 15 lakh rupees, you would consider the same. The remaining amount would become the actual tax payable. And these are the questions which are there in your direct tax for RTP Jan 2025. Thank you, everyone.